5 Principles of Financial Literacy. Hi everyone, welcome to my YouTube channel. Today is gonna be another very interesting video that will definitely add up to your knowledge, and I am 100% sure of that you will not regret the few minutes you will spend watching this video, but instead I am hopeful that you will be a different guy, having a different set of thinking pattern about money and about creating fortunes for yourselves. So let's come straight to the video. You might have heard in your life that a rich man as well as a beggar both have the same 24 hours in their life, and the rich makes millions and billions out of it, and the beggar couldn't even make up money to earn a square meal. So we come here to solve this complicated mystery for you. That why is it so? It is because of one thing: financial literacy. Financial literacy is knowing about the art of making money and spending money efficiently. A financial literate person can never go bankrupt, and a fortunate person who has money but no idea of financial literacy is at a very high risk of losing all that money. So in this video, we will discuss the 5 most important principles that are key to be a financially literate person. Grab your snacks and enjoy the video. Prioritizing savings. There is a saying in money that goes, always pay yourself first. By paying yourself first, you may avoid immediately sending your income to another person in the form of purchases. The truth is that you should pay yourself first by saving money before making any purchases. Why not reverse the equation and start by reducing savings and then assign the leftover cash to costs? This is an alternative to deducting your monthly costs from your pay before setting aside cash to save. This describes the idea of trying not to put expenditures first. Budgeting must come first. If you can accomplish this, you will ultimately start increasing your personal fortune while decreasing your expenses, which will put you on the path to establishing something worthwhile. Plan before investing. Clarifying your long and short-term financial objectives can enable you to identify the investments and planning strategies that may be most appropriate and efficient for assisting you in saving for your requirements. It's essential to make a distinction between what you truly need and what is a nice to have before moving forward with this. You may create realistic objectives that you can firmly work towards reaching by going through this procedure. And here I suggest the 2 very important mechanisms you can use to do so. Simple projection, or we can say simple cash plan. Detailed theoretical plan based on hardcore financial research. Preventing fraud and buying insurance. After you've established a sound financial plan and investing strategy, it's crucial to safeguard your gains. In order to avoid scams and identity theft, you should regularly check your credit card statements and bank accounts for errors or suspicious activity. You should also keep your passwords and documents secure. Finally, you should purchase the appropriate insurance to safeguard yourself in case of an emergency. Understand how your money is taxed. Taxes can lead to your demise if not managed properly. They could put you off from accumulating riches, since you would always see your attempts going in vain. Imagine paying a minimum 18% of tax in South Africa, as well as an additional 15% sales tax, which is known as the value-added tax VAT. That means that the government has already received 33% of your revenue. Your employer also deducts other kinds of adjustments from your pay in addition to this. Therefore, you can suffer if you don't comprehend this and, more essential, how to make certain you pay the minimum taxes. You can utilize legal tax loopholes in any nation to pay less in taxes. Billionaires like Elon Musk and Jeff Bezos are infamous for completely avoiding paying taxes during some tax years. To assist them with this, they engage tax experts to save hundreds and thousands of dollars in taxes over time. Keep in mind to use such service of tax specialists at some point when you develop your fortune. Investing. In the UK, 80% of individuals avoid stock market investments. Lack of information, lack of confidence, and a poor risk tolerance are the reasons given. However, there are a number of benefits to stock market investment. First of all, when someone buys stocks and shares, they are buying a stake in a business. After then, a person has a claim to dividend the business generates. Second, a 10% yearly return is normally provided by the stock market. Comparing this to regular savings accounts, this is much greater. An easily accessible savings account had an average interest rate of about 0.17% in 2021. Thirdly, compound interest is advantageous for money put into the stock market. Interest that is gained on top of prior interest is known as compound interest. By making investments as early as possible, you allow your money time to compound and grow over time. So this was all from my side. Do like, share, and subscribe my channel, and circulate this video among your friends and family to make them financially literate.